By the end of this video, you will understand the house sale tax. There are many reasons why you may want to sell your home. You may want to take your profits and run. Hey, Bank of America, I'm on the way. Load the vote up. You may need to upsize or downsize. Honey, I shrunk the kids again. Or maybe you just don't want to deal with owning a house any longer. The sink is leaking again? Whatever the reason, when selling your house, one thing you want to take into consideration is your potential tax liability. Now, understanding and navigating your way around taxes can be a daunting task if you're not a CPA or Uncle Sam himself. But I've done the work for you, and there is value here for everyone. I've broken my research into the following categories: those looking to sell their primary residence, those looking to sell their investment property, and lastly, those looking to sell their fix and flip project. I even included legal loopholes to help you avoid taxes on the sale of your home. So you definitely want to watch until the end of the video. But do me a favor first, like this video to save others from a tax headache, and subscribe so you don't miss the videos that can help you save on taxes in the future. Okay, let's start with our first category, your primary residence. When selling your primary residence, most people won't pay taxes at all. That's because according to Section 121 from the IRS, you won't need to pay taxes on up to $250,000 of net profit if filing single and up to $500,000 if filing jointly. If you meet these three basic requirements: number one, you own the house for at least 2 years. 2, the house was your primary residence for at least 2 full years. And lastly, you waited at least 2 full years before using the exclusion on any other primary house. Any leftover profit that exceeds $250,000 if single or up to $500,000 if filing jointly is taxed at a rate of 0%, 15%, or 20% depending on your income. Let's take a look at the brackets here. Please note, according to the IRS, you must report the sale if you choose not to claim the exclusion or you receive Form 1099-S, proceeds from real estate transactions. If you don't qualify for the capital gains tax exclusion, you may qualify for a reduced exclusion if the conditions of a qualified individual changes. A qualified individual in this scenario will be the following: you, your spouse, a co-owner, or a resident. And the reason one may qualify for and claim a reduced exclusion include the following. Number one, you moved for a new job and that new job is at least 50 miles further from your new house than your previous job, or if you didn't have a previous employer, at least 50 miles further from your previous home. And B, you changed your employment situation while you still own and live in the house. Secondly, your qualified family member living in the house has a disease, illness, or injury, and you have to sell your property to A, get them a diagnosis, a cure, mitigation, or treatment, or B, because a doctor recommends a change of residence for medical or personal care reasons. And lastly, you experience unforeseen personal, family, or environmental circumstances such as death, divorce, becoming eligible for unemployment compensation, being unable to pay your living expenses, employment changes, involuntary conversions such as your house being destroyed, condemned, or under the threat of condemnation, multiple births from the same pregnancy, twins or triplets, and natural or man-made disasters. Quick note, you cannot deduct the loss for the sale of your primary home on your taxes. All right, let's talk about rental property. If you own a rental property and intend to sell, gains from that sale will be taxed at the capital gains tax rate depending on how long you held the property. If your rental property was held for less than a year, you will be subject to short-term capital gains tax. The short-term capital gains tax is a tax at the same rate as your regular income. If your rental property was held for more than a year, you will be subject to long-term capital gains tax. Let's take a look at the long-term capital gains tax rate for 2020. You will want to check the current year's capital gains tax rate to see where your tax liability falls. Another thing to know regarding taxation on rental properties is that you will be taxed for depreciation recapture. You see, smart investors write off depreciation as an expense to to reduce their yearly tax burden. And when you sell your rental home, you will be taxed on that depreciation, whether you took it or not. So you might as well take it. But the key here is to be sure to include depreciation in your cost basis when you sell. We'll talk a bit more about that later in the video. Now, let's talk about how you save on taxes when selling a rental home. Here are 3 legal loopholes to minimize your tax hit. The first is a 1031 exchange. Loved by real estate investors everywhere, here are 3 things to keep in mind when doing a 1031 exchange. First, a 1031 like-kind exchange is a real estate investor favorite that allows you to sell one property and use the proceeds of a sale to acquire a new property, all while deferring taxes until a sale is made on the new property, if at all. Secondly, with the 1031 exchange, any cash left over after purchasing the like-kind property is considered a taxable capital gain. Lastly, while a wonderful strategy, note that the process is not simple. The rules are strict, and I recommend studying up on the rules or hiring a professional to help conduct the exchange for you, as the tax penalties for failing to do a 1031 exchange properly can be costly. The next way to minimize your tax hit is through tax loss harvesting. Tax loss harvesting is the act of selling a losing investment to offset capital gains. As it stands today, the IRS currently allows you to use capital losses to offset an unlimited amount of capital gains. As with most things concerning taxes, there are stipulations, so consult with your CPA to make sure you perform tax loss harvesting properly for you. The last way to minimize your tax hit when selling a rental property is by converting that property into your primary residence. But why? Remember that you're able to exclude up to $250,000 worth of profit if you're a single filer and $500,000 if you're married filing jointly when you sell your primary residence. And because of this, many investors resort to converting their rental property into their primary residence to help them take this benefit. Note that when taking this approach, you must have maintained the residence as your primary residence for at least 2 of the last 5 years, and a percentage of gains will still be taxed based on how many years the property served as a rental. Okay, let's talk about a fix and flip. In general, a flipper is categorized by the IRS as a dealer, and the profits from a sale will be taxed at your ordinary income tax rate. But if the flip property was held for more than a year, you will be subject to long-term capital gains tax. Here's another look at the long-term capital gains tax rate for 2020. In addition, flipper must pay double FICA taxes, Social Security, Medicare, and Medicaid taxes, in addition to any state and local taxes. All right, how to calculate your gain or loss from the sale of real estate. The formula is sales price minus cost basis equals your gain. Sales price is simple, the amount you sold the property for. Your gain is simple, the amount you profited. But many people tend to scratch their head when it comes to calculating your cost basis. Here's how you determine it. You take the original cost of the asset plus improvements to the asset plus repair or damages to the asset minus depreciation to the asset minus deducted casualty loss to the asset equals your adjusted basis of the asset, or your cost basis. So you made it to the end of the video. By now, whether you are selling your primary residence, a rental property, or a fix and flip, you should have a pretty good understanding of your possible tax liability. Please remember that everyone's tax situation is different, and it is strongly advised to consult your CPA or consider hiring a CPA from Life Accounting to help you save and remain compliant with the IRS. Thanks for watching. If you haven't already liked this video, do me a favor and hit that like button so others can see the video on YouTube. And subscribe so you don't miss another video that can help you save on your taxes. I'm Karan from Life Accounting. Until next time.